Hey, what's going on, guys? It's Marcos. Now, if you're buying a house or refinancing, I'm sure you're feeling the burn of these higher interest rates because mortgage rates are at 20-year highs with the average 30-year fixed rate now well above 7.5%. It just doesn't seem like we've hit the ceiling just yet. So let's talk a little bit about what's going on, why these rates are continuing to go up, and what you can do if you're thinking about either buying a house right now or refinancing. So if you're getting a mortgage, regardless of what your situation is. So first of all, let's talk a little bit about what's causing these rates to keep jumping. So now the main factor just continues to be inflation. Mortgage rates are extremely sensitive to inflation because they're based on the prices of mortgage bonds. And when inflation goes up, bond yields go up as well. Now the Fed has raised interest rates 11 times since 2022, and this has significantly influenced the trajectory of mortgage rates. Now typically when the Fed moves rates up or down, it doesn't necessarily affect mortgage rates, but because everything sort of revolves around inflation in today's economy, it definitely does. Now, to keep things in perspective, the last time that rates were this high was back in 2002 when the average 30-year fixed rate was about 7.14%, but they were as high as 8.64% in the spring of 2000. Now, to make matters even worse for those who are looking to get a mortgage, is that earlier this month, the U.S. credit rating was downgraded by Fitch from AAA to AA+. Now, the immediate effect is that treasury bonds began to sell off, and that further pushed up mortgage rates, which is one of the main reasons why it seems like rates are continuing to go up every single day this month in August. Now, because interest rates were at 2% and 3% from 2020 to 2021, this really affects homeowners in two main different ways, in my opinion. So the first one is that higher rates is pushing more buyers to the sidelines. I mean, we're seeing an increase in people looking at houses, going to open houses, but just simply not buying because they simply can't afford it, or they just don't want to stretch their budgets too much because of the now higher monthly payments. Now, the second is that the higher the rates are, people that already have a low interest rates are in some ways trapped in their homes, because if someone already has a low interest rate, even though they may want to sell for something newer or larger, or maybe even want to downsize, they have to face the fact that rates are 4 percentage points or 5 percentage points, and sometimes even higher than what they currently have. So not only this, but you also got to realize that people who bought a home before the COVID days have a lot of equity in their homes, and their loan balances are not necessarily extremely high, and therefore their monthly payments are also much lower than someone who's looking to buy a home right now. Now, for example, the average price of a home in the fourth quarter of 2019 was $384,900, which compared to nowadays is $495,000. So you're probably wondering, if rates are this high, and really, I mean, that's pushing a lot of people away, then at some point prices have to fall because obviously the demand is sort of slowing down. Well, here's the problem, is that nearly 92% of all homeowners have an interest rate under 6%, and roughly 4 in 5 homeowners with mortgages have an interest rate below 5%, and nearly 1/4 have a rate below 3%. Therefore, many would-be sellers are staying put rather than listing their homes to to avoid taking on that much higher interest rate when they purchase the next property. Now, this has obviously caused a lock-in effect because this is pushing inventory down and is preventing home prices from falling. This is the reason why I tell people that, well, look, yes, I mean, rates are higher, but there's still a lot of demand, and the people that are already have a low interest rate, they're just simply not selling. So more demand, less supply. That's why we are kind of where we are. So what happened when rates eventually do go down? Well, I personally believe that when this happens, home prices will continue to go up, and this is the reason why, or at least they may stay pretty stable. Now, remember that there are millions of people on the sidelines waiting for rates to go down. And because most people need a mortgage to buy a home, the number one factor that drives someone to become a homeowner is affordability, which means monthly payments, right? So as soon as rates go down, there's going to be a wave of new buyers, an increase in demand. Now, the good news is that those who already have a low rate right now may be more inclined to list their homes, even if it means giving out a 3% mortgage. Look, it's just an easier pill to swallow when you go from a 3.5% mortgage rate to maybe 5. It's just not so much when you have to go from 3 to 7, So At this point, well, you're basically wondering, when are the rates going to go down? Obviously, nobody knows when that's going to happen, but we can only guess. Now, according to Goldman Sachs, Fed rate cuts could come as soon as next May, regardless of whether we enter a recession. While Fannie Mae forecasts that the average 30-year fixed rate will remain at around 6.8% through 2023, but that doesn't expect rates to dip below 6% until the end of 2024. So what if you're buying a home right now? Well, there's a couple of strategies that you should know, and that's if you are obviously in this market or shopping for a home, whether it's right now or in the next few months, if interest rates are still high. The first one is the 2-1 buy down. Now, this is a mortgage strategy where the lender agrees to buy down the interest rate for the first couple of years, which is obviously going to get you, several savings on a monthly basis. For example, if today's interest rate is at 7.5%, then on the first year, your interest rate will be 5.5%, and then it goes out to 6.5% in the second year. Now, once you enter the third year, the rate defaults to 7.5% and stays locked in for the life of the loan. Now, one thing to know about is with this strategy is that it has to be subsidized by the seller, meaning that you do have to get a seller concession to achieve this. But here's the cool thing if you can actually make it work. Example would be if you're taking out a $500,000 mortgage at 7.5%, your payment will be about $34.96, and that's not including tax and insurance. But with a 2-1 buy down strategy, with the first year's rate of 5.5%, you'll be looking at a payment of $28.38 per month, meaning that you'd save about $657 a month in the first year. Meanwhile, on the second year, with the rate at 6.5%, your payment will be $31.60, so that's still savings of $335 a month during the second year. With this strategy, you will be able to save $7,884 in the first year and $4,027 on the second year for a grand total of $11,911. Now, the second approach that I will look at in this is going to depend on several things like your loan size, the type of loan that you're doing, and your down payment, and that is getting an adjustable rate mortgage. Now, adjustable rate mortgages or ARMs have taken a lot of heat in the past, and a lot of people are obviously very scared about them, but really this is one of the best financing options available. So adjustable rate mortgages are fixed for the first 5, 7, or 10 years. So that's going to give you a lot of time to do something when the adjustable period starts to come up, right? Now, personally, I will only look at the 5-year fixed adjustable, and that's because 5 years is a long time. I might not keep the house for 5 years. I might not even keep the mortgage for 5 years, but it's going to give me a better interest rate than a 30-year fixed mortgage. Also, out of all the 3 adjustable rate options, which again go 5, 7, and 10, the 5-year ARM is the one that gets you the best interest rate. Now, during that period, once again, you could do whatever you want. There are no prepayment penalties, so you can refinance or you can sell, so it's not something that you have to live with for a long time. As of right now, the rate on a 5-year adjustable rate is about 7%. So this kind of goes back to really kind of how much mortgage are you getting? Because if you're only financing roughly, say, $200,000, $300,000, then it probably doesn't make too much sense to get into an adjustable rate because the rate difference isn't too much. But if you are looking to get $1 million mortgage, for example, then there is a pretty big difference between, say, 7.5% down to 7. So there's, one of the reasons as to why I will look into an adjustable rate loan. Now, lastly, I will look into buy points. So when you buy discount points on a loan, you're basically prepaying your interest rate in exchange for the lender to, give you a better rate that's just simply not available right now. So you get a lower interest rate, just sort of have to invest in and pay for it, whatever. Now, purchasing points is a really beneficial strategy if you plan to stay with the mortgage for at least a couple of years. And this is because the upfront cost of buying the points is recouped over time through the lower monthly payments. So if you're really only planning to stay with the mortgage for, say, less than a couple of years, then you may not even reach the break-even point where the savings from the reduced interest rate surpass the upfront cost of buying the points. So in essence, buying points is more of a longer-term investment. So the longer that you really stay with the mortgage, the more that you are going to save. Now, if you were to ask me what I would do if I were buying a home right now, as a mortgage professional, I will make sure to get seller pay concessions, if that's possible, obviously. Now, whether that's to lower your, out-of-pocket expenses, obviously pay for the closing costs, or maybe to help you get into one of these 3 strategies that I mentioned above. Honestly, obviously, not every market is the same. Some markets are extremely competitive. I'm in the South, which is still a very hot market, even though demand has definitely slowed down. So it's a little bit tougher for a buyer to get seller pay closing costs where I'm located, but it is definitely very possible because I've seen it. This is something that I do every single day. So if you are buying a home right now, or maybe even the next few months, just do all you can to get the seller to pay for your closing costs. All right, guys, hopefully this video helps you understand what's going on with the mortgage rates, gives you some strategies to consider if you're buying a home right now. Hopefully these strategies are going to help you save some money. Let me know if you have any questions in the comments box below. I gladly appreciate any questions. I will gladly answer them for you. And I definitely appreciate you guys for watching this video, and I will see you next time.